The world is in shock. Global financial markets are reeling from a sudden catastrophic event. A tidal wave of panic has swept across the globe, leaving investors scrambling for safety. What triggered this financial meltdown? The answer lies in the heart of Japan. For years, a colossal financial gamble has been quietly unfolding. It's called a carry trade. Imagine borrowing money cheaply in one country, like Japan, and investing it in assets with higher returns elsewhere. It's like finding a magic money tree, but this seemingly lucrative strategy has just turned into a nightmare. To understand this crisis, we need to grasp a complex financial concept, the carry trade. Imagine you borrow money at a low interest rate, let's say in Japan where interest rates are near zero. Then you use that money to invest in assets that offer higher returns like stocks or bonds in other countries. The difference between the interest you pay and the interest you earn is your profit. This is a carry trade. Over the years, Japan has become the epicenter of this global financial gamble. Its ultra-low interest rates have made borrowing yen incredibly cheap. Investors worldwide flocked to Japan to borrow yen and invest in higher-yielding assets. This massive influx of borrowed yen fueled a global carry trade frenzy. However, this seemingly risk-free strategy has met a perfect storm. A combination of factors has triggered a rapid unraveling of these carry trades. Weak U.S. economic data, including a disappointing jobs report, has shaken investor confidence. The tech sector, a darling of investors, has also suffered from a slump in earnings, further dampening market sentiment. Adding fuel to the fire, the Bank of Japan has shown signs of potentially tightening its monetary policy. This shift away from ultra-low interest rates has sent shockwaves through the market. Investors, fearing higher borrowing costs in Japan, are rushing to unwind their carry trades. The massive sell-off of assets to repay yen loans has created a vicious cycle, sending shockwaves through global financial markets. This is the carry trade tsunami. The impact of this sudden unwinding of carry trades has been catastrophic. Global stock markets have plunged into a state of panic. Major indices like the Dow Jones, Nasdaq, and S&P 500 have suffered steep losses. Investors, caught off guard, are desperately trying to offload their assets to meet margin calls. As fear grips the market, investors are seeking refuge in traditional safe haven assets. The Japanese yen, ironically the currency at the heart of the carry trade storm, has become a sought-after haven. Its value has surged as investors rush to buy it back to repay their loans. The Swiss franc, another classic safe haven currency, has also seen a significant uptick. The situation is dire, and experts are scrambling to make sense of the chaos. Kit Jukes, chief foreign exchange strategist at Societe Generale, warns, quote, "You can't unwind the biggest carry trade the world has ever seen without breaking a few heads. That is the impression markets give us this morning." Russell Napier, co-founder of ERIC, believes we've witnessed a glimpse of the yen carry trade's potential for destruction. He warns of a potential implosion of the carry trade. However, Ed Rogers of Rogers Investment Advisors offers a glimmer of hope. While acknowledging the panic, he maintains that the yen carry trade is not dead. He believes that the current turmoil is a temporary correction and that the underlying interest rate differential will continue to attract investors. As the market grapples with this unprecedented turmoil, one thing is clear: the consequences of this carry trade collapse will be felt for some time to come. The recent spate of economic data from the United States has painted a concerning picture of a potential economic slowdown. Indicators such as GDP growth, employment figures, and manufacturing data have come in below expectations, fueling fears of a recession. These weaker-than-expected numbers have eroded investor confidence in the U.S. economy, the world's largest. When investors lose faith in the health of the U.S. economy, they tend to reduce their risk exposure. This often translates into selling off stocks, bonds, and other assets. As a result, the overall market sentiment deteriorates, leading to a downward spiral in asset prices. Moreover, a weaker U.S. economy can negatively impact global trade, as U.S. consumers tend to reduce spending on imports, hurting economies reliant on U.S. demand. This interconnectedness amplifies the impact of U.S. economic weakness on the global market. The Bank of Japan has maintained an ultra-loose monetary policy for an extended period. keeping interest rates at historically low levels. This policy has been a cornerstone of the carry trade phenomenon. However, as global economic conditions change and inflationary pressures emerge, there is growing speculation about a potential shift in the Bank of Japan's stance. A shift towards tighter monetary policy could have profound implications for the global financial system. If the Bank of Japan starts to raise interest rates, the cost of borrowing yen will increase. This would make carry trades less attractive, prompting investors to unwind their positions. A mass exodus from yen-funded carry trades could trigger a sharp depreciation of the yen, causing significant volatility in currency markets. Furthermore, a stronger yen could negatively impact Japanese exporters as their products become more expensive for foreign buyers. This could lead to a decline in Japanese exports and, consequently, a slowdown in the Japanese economy. Given Japan's significant role in the global economy, a weakening Japanese economy could have ripple effects on other countries. Therefore, the Bank of Japan's monetary policy decisions are closely watched by investors worldwide, and any change in stance has the potential to cause significant market disruptions. The recent market turmoil has sent shockwaves through the global financial system, leaving investors scrambling to assess the damage and navigate the uncertain road ahead. Fear of a global recession. The rapid unwinding of carry trades, coupled with weak economic data, has instilled a deep sense of fear among investors. Many worry that the global economy is teetering on the brink of recession, leading to a significant decline in corporate profits and asset prices. Dash to safety. As fear takes hold, investors are abandoning riskier assets and flocking to perceived safe havens like gold and government bonds. This flight to safety is putting further downward pressure on stock prices and exacerbating market volatility. Uncertainty about the future. The unprecedented nature of the current crisis has left investors with little guidance on how to proceed. The future direction of the market remains highly uncertain, making it difficult for investors to make informed investment decisions. In times of economic turmoil, it becomes increasingly important to monitor credit spreads. These are the differences between the interest rate on a corporate bond and the interest rate on a government bond with similar maturities. Credit spreads are a vital gauge of investor sentiment and credit risk. During periods of economic stress, investors become more risk-averse. They demand a higher premium to hold riskier corporate debt, which causes credit spreads to widen. Monitoring credit spreads can help investors identify potential problems in the credit market and make informed investment decisions. The global financial system is still recovering from the shock of the unwinding carry trades. Weak economic data and the possibility of central bank policy changes are adding to the uncertainty. Investors should brace themselves for continued market volatility in the coming weeks and months. Here are some additional tips for navigating a volatile market. Stay informed. Closely monitor economic data, central bank pronouncements, and company earnings reports. Maintain a diversified portfolio. Invest in a variety of asset classes to mitigate risk. Invest for the long term. Don't make impulsive decisions based on short-term market fluctuations. Seek professional advice. Consult with a financial advisor to develop an investment strategy tailored to your individual risk tolerance and financial goals. By staying informed, maintaining a diversified portfolio, and having a long-term investment perspective, investors can weather the storm and emerge stronger on the other side. We've witnessed a seismic event in the global financial landscape. The unwinding of massive carry trades, triggered by a perfect storm of factors, has sent shockwaves through markets worldwide. From the dizzying heights of euphoria to the depths of fear, investors have experienced a roller coaster ride. The implications of this crisis are far-reaching. A weakening U.S. economy, coupled with the potential for a shift in Japanese monetary policy, has created a perfect storm of uncertainty. As the fallout continues to unfold, it's crucial to stay informed and monitor developments closely. If you found this video informative, please give it a thumbs up and subscribe to our channel for more in-depth analysis of financial markets. And remember, investing can be complex. Consider consulting with a financial advisor to create a personalized investment strategy. The future of the market remains shrouded in uncertainty, but one thing is clear: this crisis has fundamentally altered the investment landscape, and those who can adapt and navigate these turbulent waters will be best positioned